Welcome to the Personal CFO. Today we're going to be talking about two important financial ratios when looking at stocks or the markets to understand, is this investment appropriate for my portfolio? And so the two ratios we're going to be looking at are price to earnings and price to sales. Now, we've talked about this in past videos, but I think it's important to bring it back up because we have a pretty good stock that we can use as a piece to just go through, make some comparisons, and hopefully get a better understanding of these two ratios. And so the stock that we're going to be looking at specifically is Nvidia. Now, this stock has been in the news lately. They essentially make some of the computing power behind a lot of this artificial intelligence that you might have been hearing about. And so people are getting really excited about this artificial intelligence, the tools that they might be able to use it for, and the implementations. And so Nvidia stock price has been going up dramatically. Now, if we want to look at these two numbers, price to earnings and price to sales, let me walk you through what these mean. So price to earnings is just what it is, the stock price over its annual earnings. And what that means essentially is how much are you paying for every dollar in earnings of the stock. Price to sales, same thing except it's for sales. So that's top line revenue, which means before expenses and all those things, how much are you paying per dollar in sales of that stock. And so I want to look at Nvidia specifically. This chart has both. And so let's first look at price to sales. Okay, so if you look at Nvidia, its price to sales ratio is 29.4. Okay, what does that mean? Well, it means if Nvidia were going to give you every dollar that they got in, not every dollar they earned, but every dollar in revenue. So they have no expenses at all. Dollar comes in from one of their customers, they give it straight to their shareholders in sales. It would take 29.4 years for you to get your money back if their sales stay the same. Now you go, well, is that a lot or a little? I don't really know. It's incredibly high when you consider that the S&P 500, if you look down at the bottom, is trading closer to 2 times sales. Now, that makes sense. Okay, 29 times. What about earnings? Because remember, these companies, they have buildings, they have technology they have to pay for, they have people, employees, teams, etc. Well, what if you took the earnings from those companies? How long would it take to get paid back? Well, with Nvidia, let's see, it's 182 is the price to earnings. So if you took the earnings, it would take 182 years to get paid back. That's before making money, to get paid back when you buy the stock. Now you might think to yourself, why would anyone buy any of these companies trading at these valuations? Well, when you're looking at something like this, the reason the valuations can get this high is people have an incredibly high expectation for growth in the future. And so they say, well, if growth doubles and doubles and doubles again, these numbers actually come down because your sales number goes higher, all your earnings goes higher, these numbers become more reasonable. And so what these numbers are is an aggressive bet for the future. Okay, well, how is it played out if we were to zoom out when we say expensive stocks can become a better deal if they grow into it? Well, how has that worked? Well, we can look back, and if you look back over history, and we've talked about this before, the price you pay for investments matters. And if you broke it down into quintiles or groups of 5, this chart here shows you, well, what happens if you buy the stocks in the most expensive quintile or stocks in the least expensive quintile? And as you can see, it's a pretty straight line in the sense of the most expensive stocks have a relatively low forward-looking rate of return. Right? So if you bought the most expensive stocks, you averaged about 3.5%. If you bought the least expensive stocks, you averaged over 14%. So that's a pretty big difference. Now, what that means is people are not amazing at predicting the future. What do you know? And so as we're anticipating these huge growth numbers, that can be tricky when hitting your long-term goals. And so when you're looking at your investments, look at the headlines, of course, and say, hey, that sounds great. Sounds like these companies are doing well. But more importantly, what are you paying for other people's anticipation of the future? I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.